Let's pick up on the market conversation forward. We have with us market expert Ajay Bagga joining in on the show right now. Ajay, hi, good afternoon. Firstly, wish you a very happy Diwali from all of us here at ET Now.
Thank you, Aisha, and heartily reciprocate it for all viewers and the entire team.
Right. So Ajay, just wondering how can Diwali be happier? Should one already be buying this decline in the market or still wait it out and wait for the dust to settle down?
No, I think very tough to answer this question, but there are opportunities emerging. But definitely we can wait it out, especially till about 6th, 7th November, till the US presidential election clarity emerges. There won't be much difference in the two policies, even though the rhetoric is quite vitriolic. But we expect that policies will be on similar grounds. But I think China is better prepared. They've already announced a stimulus, and one more stimulus is up its arms because they are expecting tariffs to come in, irrespective of the who wins. And with Trump, it will be higher tariff, more rhetoric, and with Harris, it will be maybe lesser tariffs and more focus on the poorer segments. But anti-China sentiment is very widespread. It's like 1980s. I remember when Ronald Reagan was the president, he took a hammer to a Japanese car outside the White House, and he broke it with that hammer. So that's the kind of sentiment against Chinese manufacturing hollowing out the US. So expect that. We are collateral damage in those EM outflows. The second big part is the US economy doing very well. So with that US exceptionalism of holding up its economy, we are seeing more and more flows still going to US stocks. 145 billion have gone into US-based ETFs from Asia and Europe this year, which is a record number. Every week, we are seeing very strong inflows into the US stock market. So entire EM flows are suffering because of that. We have not really had Chinese inflows for the last 2.5 weeks. In fact, when the stimulus was announced, China saw 53 billion coming in 2 weeks. And that's when the market went up very sharply. But over the last 2.5 weeks, about 15 billion, 1.5, has gone out of the Chinese markets as well. So it's, US dollar strength, US yields up, US exceptionalism in economic terms, and then the presidential election, where a few thousand votes will actually decide who takes the White House. So out of those 7 swing states, if you see the Biden-Trump difference, it was 43,000 votes, Aisha. So this time also, probably 50,000 odd votes will decide who takes the White House eventually. And markets will be very volatile going into that.
Yes, markets have been volatile and expected to stay like that for the next couple of weeks. Perhaps be very cautious if you're looking at trading in the market, or just stay away till the time that clarity emerges. That's the view coming in. But Ajay, hi, this is Anisha joining in the conversation and wishing you a very happy Diwali as well. Wanted to get a better sense from you regarding the other asset class which has been shining bright this year, and that's clearly been gold. Given the entire volatility and the narrative that you were talking about, do you expect that rally in gold to continue?
Yeah, right now, yes, because the demand is quite strong. Though World Gold Council today, I saw a Reuters reportage saying that Indian demand might slow down, but that's very marginal. From about 765 tons, it might go down to 750 tons this year because of the elevated prices. But the Chinese investors, remember 70% of China's wealth was sitting in the property market. And as against our $6 trillion of residential property market, that's a $60 trillion market, which has got cuts of 20 to 30%. And a massive amount of unsold inventory, massive amount of mortgages running, but construction not started. There is a lot of trouble in that Chinese property market. So the incremental savings and investments are going into gold. So they have these gold bullets, what they call 1 gram, 2 gram, small pieces of gold, which are being bought by the Chinese investors month on month. And that's been happening for nearly now 12 to 18 months. That's the fundamental behind the gold price. The third big contributor is the central bank. So from about 6% of FX reserves sitting in gold nearly 10 years back, today we are at 11% of FX reserves sitting in gold. So there is a de-dollarization, de-westernization post-Ukraine, but there is also an attraction for gold against a dollar where, there is concern. If you look at the US debt, it's rising at about $1 trillion per 100 days. So just in the next 1 year, you will have 3.5 trillion more. It will probably cross 40 trillion. US interest outgo has reached $1 trillion with these enhanced rates. And still a lot of the US outstanding gilts have to be repriced. So it's not that fully the treasuries have been repriced. And already 23% of US budget is going just on interest servicing. We are beneficiaries. The big bonanza that RBI gave to the government was largely based on what we earn on our US, Euro and Japanese FX reserves. So we will benefit this year also, as against 0%, we'll make 4.5% again on that massive 700 billion of FX reserves. So we are beneficiaries of that. That's a second order effect. But the first order is, it's helping gold overall.
Interesting. Kunal, what's your analysis? You think that volatility is only going to heighten, and given that our market construct is as it is weak, can we expect further weakness as we approach closer to US elections, which is in the first week of November?
Yeah, I looked at the markets over the last many decades, and it looks like that liquidity-based sell-offs, they are very, very short-lived, and we've seen historically that leads into sectors falling sharply, or the markets correcting aberrations in the sense if there are any excesses which gets created in terms of sectors which are overbought, stocks which are overbought, and indices which get back into a string of strong outperformances. So the market tends to correct those, but once that correction happens is where the markets finds its feet pretty much on the back pretty much quickly, and we get back into a V-shaped recovery for many of the stocks. And there are of course new leaders which emerge with every kind of uptrend which resumes post the sharp correction. So for example, over the last 1.5 odd months, we've already seen a 7 to 8% correction broadly for the Nifty, almost like a 8 to 9% correction for the bank Nifty, and many of the sectors, for example the auto stocks, the energy sector, etc., many of these sectors have already corrected by 15 to 20%. So when you see such kind of a sharp corrections into individual spaces, my sense is that the markets are just about going through a phase of correction rather than a major reversal. Whenever that settles, I would believe that we should be on course of coming back into strength for the indices. Now the point over here is very, very important, which that once the market gets back into its feet, or gets back into a recovery phase, which are the kind of sectors and stocks which would tend to give stronger leadership stance. And I think in that sense, I would probably believe Bank Nifty, and especially the private sector banking names, as well as select PSU banking stocks, I think they are the ones which could probably be amongst the first ones to try and pick up pace. If the IT stocks also manage to recover over the next 1 week, and especially the large cap IT names like HCL Tech, TechM, Infosys, etc., then I would believe that even IT stocks could probably follow the lead. So I would probably be of the view that this could be a phase where longer term traders could start to look to accumulate as well.
Okay, accumulate as far as the long-term traders are concerned. Before we head into the break, Kunal, what's your view on gold and Bitcoin, these two asset classes? Ansh was just telling us how they have done very well in the last somewhat. What about the coming year?
See, I believe gold has run its part to a major extent. Now I would probably believe that it's time for Bitcoin to try and give a big breakout. In fact, the charts for Bitcoin are very, very interesting. It's almost like a a rounding bottom formation for Bitcoin, and a flag formation. So a lot of combinations of technical patterns which are being formed for this asset class, and I would probably believe that that's generally a sense that the markets are getting into a risk on mode. And then we try and look at what's happening across the US indices and the global indices. So except for our markets, I think there's been a a far more stable index trends across the globe, and especially in the US and the European indices. So I think in that sense, I would probably believe that Bitcoin could be the next bigger trend in terms of a breakout over the next 12 to 18 months at least.
Okay, so that's a chart telling you on Bitcoin, but do remember it's a risky asset, very volatile, so be very cautious and careful when you perhaps trade or invest in that one.
And we're still in the week as we speak right now. Let's just check in on what the global markets are up to, because they also are seeing pretty much the same fate all across. Over 100-point knockoff for the DAX. The FTSE is well lower by about nearly 8/10. Similar is the picture for the CAC, and 140 points lower for the FTSE, MIB and Stock 600 as well. But let's talk about what really is happening in our market. We've been flagging off as to how technology is the weakest link today. That, along with FMCG, banks as well, not really holding out well. There are blue chips like Reliance, Bajaj Finance. They're also sub that 1% cut is what they're seeing right now in trade. But Ajay, how is it that you're now navigating within the private banking pack? Once again, it seems like the consensus trade, but what is it that you are picking out from this pack?
No, absolutely. And, Kunal summed it up very nicely. I'm totally in agreement with him. The top end 4-5 private sector banks and the top 4-5 public sector banks. That's your outperformance area. Industrials, then FMCG on a contra bet. What we are expecting is that if you look at the government expenditure numbers, by September they have caught up, but you have seen nearly 2 lakh crores extra of government revenues. If you look at the gross tax collections, that's nearly 2.25 lakh crores extra. That's the kind of money which has gone out and not come back. So what you would have really liked to see would have been some counter cyclical ballast given into this economy, like what China is doing. They are also, it's not that China is in a negative GDP and they are trying to stimulate themselves. It's more 4.25% GDP they're trying to take to 5%. And based on that, they brought in the stimulus. It might be too less given the size of the property crisis in China. But I think the government has a lot of fiscal space now where it can stimulate the economy, give some pump priming into the economy, cut some rates on, say, petrol, diesel or something, give up some of your revenues and, or, say an automobile, give a stimulus to that segment. Very targeted stimulus can help the economy again go back very sharply. Despite that, I don't think much will happen. But despite that, the second half should see consumption picking up. The government infrastructure has been year on year slightly lower. And these are September end numbers. The earlier numbers, it was sharply lower. And we were expecting nearly a 40% pickup in infrastructure would be needed in the last 6 months to make up. But they seem to have moved out. Now, I don't know if that is money spent from finance ministry into another ministry and not really gone on the ground. That we will have to wait and watch and study the data much deeper. My own thesis is that money has not reached the ground so much. It's lying in some department and shown as expenditure from the general pool. That will come back and that will have an impact. And there the beneficiaries, the two very big beneficiaries will be banks and the industrials. You will see them rocket off. And FMCG, because it's so beaten down and everybody's writing it off, that would be the third. IT has been another call which I've been making for the last 3 to 6 months. Today is a bad day to say IT after Meta and Microsoft disappointed, and we have seen the whole sector getting sold off. And then we have Apple and Amazon tonight in the US. We'll have to wait and watch those numbers. But IT turnaround is coming. Those use cases for AI are coming. And the amount of money being put in AI, that will engender better things. The model will change. What really caught the market's attention was Google saying 25% of their coding is now done by AI. And then engineers test it, engineers make it more robust and they launch it. But 25% of the basic coding, which an engineer sitting in India or offshore would be doing, that is now being done by AI. So we'll have to move up the value chain, but at least 8-10 companies in India are there who will be able to do that, and not the entire world geography is moving that fast. Korea and Japan, for example, are laggards. So there maybe we pitch for more. Europe, again, there are other issues, but US will really lead this AI push, and we have 8-10 companies who can engage and benefit from that.
Okay, Mr. Bagga, on that note, we let you go, and here's hoping the next year is even brighter and prosperous for you. But
if you like this video, then like, share and subscribe to ET Now.